Stop tipping the government. Don't give away money that's rightfully yours. Don't make these mistakes if you value your money. Look, there's tons of scams out there when it comes to taxes. I'm going to help you identify those. If you're afraid of an audit, I'm going to tell you exactly what to do to eliminate that fear and how to actually get money back. And how important it is to review past returns every 3 years. How it doesn't make sense to spend to save unless you're going to spend the money anyway. And if you haven't classified income for taxes, then you're definitely overpaying. We'll go over the missed deductions that people have and why most people are too one-dimensional when it comes to taxes, and the difference between deferral and being afraid of taxes and being reactive and what you can do instead. So look, money loves momentum. Fast money wins. So how you pay yourself matters. If you can move from active to passive, the type of corporation you choose will absolutely make a difference. LLC is great for flexibility. Where an S Corp's better as like a cash cow, a solo corporation. Where a C Corp, if you're going to raise funds or retain earnings, that could be key. Here's a cool strategy. This is a great strategy because not only will it save you tax, but it can actually help you teach your kids. You can pay your kids around $13,000 tax-free per year. Now, here's the caveat. They have to do the work. And it really depends on the type of corporation, whether that's completely tax-free to you or whether you still have some self-employment taxes. Let's think about taxes for a minute. It's kind of a ream, right? Do you know when you pay taxes, don't you think, oh, at least my taxes are going to good use, right? Like in my home state of Utah, there's actually a law that says it's okay to marry your cousin as long as you're over 65 because, well, of course there is. First off, I don't know why you have to wait until then. It's creepy. Also, I'm not sure it says how old she has to be, so double creepy. And that's an actual passed law. Do you know how much time and money it takes to have a session and pay 75 state representatives, 29 state senators, draft a bill, introduce that bill, have a committee review it, then send it off to the governor so he can finally approve it and pass it into law? Millions? Also, some 65-year-old perv has legal permission to marry their cousins? Go Utes. This is where our tax dollars are going. And most people don't even know how to properly save on tax, so they end up overpaying, which is like tipping the government. Look, I like tipping. But this is like tipping a waiter who ate 37.5% of your meal and then peed in your soup. Tipping's a great way to say thank you. Job well done. Not something I typically associate with the government because, well, they're the government. You know, the one that says, don't worry, it's going to get better. I won't hurt you again. I promise. I'm not going to hurt you by raising taxes. It's like an abusive boyfriend. Okay, Jeremy, but this is the last time. The only thing I trust the government to do is stupid things with our money. Plus, taxes are like the government's heroin, and they're addicted. They're so good with money. The government's $36 trillion in debt. That's a 30 followed by 18 zeros. 18. Okay, not really. Only 12 zeros, but I said 18 for years, and nobody corrected me because it just seems ludicrous at that point. That's debt that your great-grandkids get to inherit if they're not extinct. So let's go over the top 10 tax mistakes and what to do instead. The first mistake is being reactive instead of proactive. Having no rhythms. Like when I go to the dentist, I schedule 6 months out for the next appointment, right? There's a rhythm to it. So if you don't have a rhythm to meet with your tax team, then it's not something that's usually that you want to do, you know, just like a lot of people don't like going to the dentist. I like having that fresh, clean feeling on my teeth. My dentist was my roommate, and I don't know, like we work with a lot of dentists. I don't know why they get such a bad rap. I don't understand why people are afraid of that. The other issue with being reactive is people don't track. And if you don't track your dollars and your numbers, then what happens is people usually wait until the next year. And they're like, okay, I finally got my stuff together. They filed their extension. And now most of the strategy is deferral instead of savings. So if you can track and you can meet at least quarterly, then you can start to brainstorm, what can we do? You get an idea of where you're at with your business and your finances so that you can start to strategize ahead of time. And that's where the real tax strategy exists. You know, most people are waiting a year too long, or they're talking during the brain dead season. If you're meeting with your accounting team between January and April, they're so busy trying to file that it's hard for them to be really productive. They're not getting enough sleep. So don't wait too long, especially if you're going to sell assets. I know tons of people that sell a business and then they go, what should I do to save tax? Well, that should have been planned well before. And there's a number of things you could do before, but as soon as you sign a letter of intent or hire a broker, those are gone. So the second mistake or issue is this fear of buying into the BS of conservative tax historians. Conservative. Like, I get it. If you fear the IRS because we don't know enough about the tax code, it's easy to say, oh, I'm just going to hire someone conservative. I want red flags. Look, if they tell you their job is to keep you from being audited, the government wants to audit you at least once during your lifetime. And there's a few different ways that people get audited. Like, if you just have on your tax form everything rounded, and there's just like, it's always instead of 32 cents, it's 00. Like, that's suspect. If you get random audits, that can happen for sure. But here's the deal. If you're a business owner and you don't incorporate, there's a 400% higher chance of audit. So there are things that you could do that get you audited. And I'm going to give you a place you can go to make sure you don't get involved in the things that definitely get you audited, because there's too many tax promoters out there that are actually already on a list that the government's watching, and they're still out there trying to promote stuff. These tax promoters create far too many problems. And they're the ones that get us to think, oh, I want to be conservative. Because if it doesn't make sense to you, like, why would the government do it? Here's one that's going on right now. Oh, you could buy these tribal credits from the Native Americans and get these. Why would the government want or allow that? That immediately has a red flag. But if it's I have a home office and I use it and I want to write that off, that's not a red flag at all. Or if the government puts out a code like Section 199A or Section 280G or 132J or these different things that are right there that allow you to write off your home for your business up to 14 days a year, or write off maintenance for a gym that you have at the home that you allow employees to use. These are things that are right there in the tax code, and yet conservative accountants are usually reactionary or admitting and telling you ahead of time, look, I'm not going to get you everything that's out there because I'm too busy filing. And they're not really trained. It's kind of like MDs aren't really trained in nutrition. When they go to school, they're not learning about nutrition. I had MDs that gave me the worst nutritional advice. I went to school and they taught the food pyramid, for crying out loud. That's crazy. And that's kind of where we're at with accounting a lot of times, is if you're not proactive, you don't have someone that's a tax strategist, or you have someone that's just telling you they're conservative, I would call that a red flag. Now, the third issue here is when people defer instead of getting credits and permanent savings. So credits, those are great. Permanent savings and real deductions, not just deferrals, those are so helpful. Let me give you an example. So if I put my money in a retirement plan, that's a deferral. If I write off a home office, that's a deduction. That's two different things. One permanently saves me tax. The other one just defers it into the future. So you got to be careful about thinking you're paying less tax just because you've set the problem up to be worse in the future. Look for real credits and real savings. The fourth issue with accounting is a lot of people are just one-dimensional. Part of the reason we're one-dimensional is there's a missing model. So you have to have a team. If you just have one person and your business that's growing, you're probably going to overpay tax. You might have outgrown that professional as you grew your business. You want to have a tax strategist that maximizes your deductions. You want an attorney that sets up the right corporations, and maybe even a tax attorney that helps you to reclassify your income. The fifth issue here is just missing deductions. Like, if you feel like you might be missing deductions, you should get my tax navigator. Go to Garrett Gunderson on Instagram. You should give it a follow. Those are really short, daily doses of prosperity and tactics and strategies that can help you out in a couple minutes. But you can ask for the tax navigator by just sending me a DM, and I'll hook you up. It's going to give you a checklist so you can find out, are there deductions that you're missing? What are some of those deductions? I mean, the Augusta rule that I mentioned is a very basic one that you can rent out your home to your business. 132J with the equipment, 199A, which is a qualified business deduction. That's a big one. There used to be, more emphasis on R&D credits, which could be great, and those are super helpful. There's plenty that's out there. There used to be domestic production credits, and they're changing tax laws all the time. I know that when they changed for 199A in 2017, a lot of people missed that for years, and that took my tax rate from 37 to 29. It was super helpful. But if you miss those missed deductions can cost you. Paying your kids, that's a deduction if they're actually doing the work. I had my youngest introduce me when we did my comedy special. You can see it on Amazon Prime. It's called The American Ream. So he got paid for that. My oldest is filming this right now. My youngest helped me memorize my one-man show theatrical keynote. It's a marquee keynote where I'm taking people through the Money Unmasked book in an experience using entertainment to educate. So there were these real things I could pay them for. You know what? If you get my Rich Life Bundle, usually I don't, try to sell, but the Rich Life Bundle are these 3 books. But what it comes with is a Legacy Builder course when you get What Would the Rockefellers Do? And in the Legacy Builders course, I really thought through and I said, what are like 20 things you pay your kids for? Not mow the lawn and organize files and all this kind of stuff that, it's hard to really pay them much for, but things that would really teach them great responsibility and increase their skill sets. And then you could actually pay them. And by the way, they're minors, so you still control the accounts, but you're going to pay less tax by doing that. So far too many people miss deductions. Let's go to the 6th point here. Not properly classifying income. If you can make active income more passive, that's going to save you. An S Corp taking distributions, you're not paying self-employment tax on the distribution. Ordinary income to capital gains. Now, maybe you have a business in the United States, but you do a lot of business internationally. You can set up an international sales corp or an ICDISC, and that money comes into that sales corporation capital gains. So if you're making a lot of money and you're over in the top tax bracket at 37%, you can get some of that income down to 20%. Not that this would apply to everyone. I'm just giving you examples. Tax-free, that's another way to reclassify income. Section 1202 on a C corporation would be one example, or a charitable remainder trust or donor-advised funds. There are tax-free options, especially for your business owner. Now, the 7th issue here is most people, they spend $1 to save 37 cents. I call that the tax tail wagging the dog. Tax arbitrage is a better option. Spend $1 and save more than $1. Let me give an example. In Europe, the way that they fund museums is they buy the art. That's how Europe works. In the United States, it's a donation-based system, which means if you donate art to museums like I've been doing since 2009, often you can get much more of a tax advantage than what you spent for the art. So we decorated our 45,000 square foot building with all this art and our home, and then every year we just donate to different museums. And it gave us back $2 for every dollar we spent because I bought collections at a deep discount because I wasn't selling them and I was buying a collection instead of one piece. And then when I was donating them, it was the full appraised value. That's an example of tax arbitrage. There's a lot of abuse in tax arbitrage, though. Like, there's a thing called the conservation easement. And a conservation easement is maybe you own some land and you never want to have it developed. Maybe you've got like this beautiful property and you love the land around it, and all of a sudden there's more development that's coming around you, and you can say, let's assess what those development rights would be, and we're going to forfeit ever being able to develop this, and we'll get a tax advantage. That's perfectly legal. It's fine. Just know that, that's kind of a generational thing that you're not going to be able to develop. But then we started to see syndications come out where there were multiple people saying, oh, why don't we get a bunch of people to put money in? We'll buy the property, and then we'll just do a conservation easement. And then it was unrelated parties, and that got put on kind of the list, and then all of a sudden it got audited. So you can see that there's a good strategy, but if it's applied a different way, it could become a problem. But that's an example of tax arbitrage or a historic easement. Maybe you buy a property that's historical and you promise to preserve the facade. You can have tax credits for that even while you office in there. So tax arbitrage is you spend $1, you get more than $1 back, rather than most people spending $1 to get back 37 cents. I know a lot of people that take Section 179. They buy a vehicle they don't want over a certain poundage, 5,500 pounds, I think, and they write it all off in that year. But now they're buying a depreciating asset that they might not want simply to save on tax. Now, if that is an appreciating asset, it appreciates, then that's fine. But if it's something that you weren't going to buy anyway, kind of reconsider. The 8th issue here is most people never review past returns. They simply just have their tax team, and their tax team kind of gets used to them. And, I always, every 3 years, bring a different set of eyes. You can amend your returns. We had someone that just simply overpaid because they had multiple companies, so they're paying all of the self-employment tax that they had already maxed out. They got back $321,000 by amending the returns. There's no risk in that. It was just money they simply overpaid. There were people that missed R&D and DPAD credits. We were able to go back and amend. Or there's a thing called NOL, net operating loss. There's some years where you might have really high expenses because you're developing, and the next year you have a lot of profit. Well, you phase out your expenses over time that you can only write off 80% of operational expenses. Net operating loss means let's match a high interest or a high operational expense year with a high profit year, and that mix and match is something you can do. It's part of what they allowed after COVID so that you can go back and amend that. Now, why don't people amend? Is because they're just so used to their tax team, they're not organized, they miss some of the points we talked about before, or not everybody can go amend. Some things, when you miss the deduction, you miss the deduction. You can't say, oh, I meant to take the Augusta rule or pay my kids last year. Sorry, you missed that. But if it's a credit, like an R&D credit, that is something you can go back. Or if it's an error, that's something you can go back. I've done this a couple times. Unfortunately, had some good friends and business partners die in 2006. And I was trying to keep 3 offices going and 42 employees while mourning, and a lot of our employees were mourning, and it was chaos. So I didn't meet with my tax team every 3 months. I didn't keep good record keeping because I was just trying to hold it all together. But then in 2008, I was able to go back and get back from 2006 and 2007 what I overpaid, and that was $40,000 federal and like $15,000 for the state. We actually still have copies, and we've shown it before. Like, here's the actual, what we got back because we amended. Then I actually was able to take R&D credits and DPAD credits way back in not way back, but like in 2017. So I got back $90,000 for that. So those are examples of amendments. Here's another mistake. People have a fear of an audit. If you have a good tax team, there's no reason to fear an audit. How to handle an audit is, first, just be organized. And 2, you never attend your audit. You don't talk to the auditors. That's what your tax team is for. Because if they don't have the answer, that's okay. They can talk to you to figure out the answer. But if you don't have the answer, that's a problem. And, your tax team is going to have a direct line to the IRS. You're not. So if you're organized, then the key is, like I once had this guy, we became really good friends. I was working with him he was a client. He told me he had the best accountant in the world. And he was still happy with the program. He just said that there's no reason to look at that part of the program. And I was like, well, humor me. If you meet with our accounting team and we save you tax, you can take me to a Bears game. He's like, okay. And I said, if we don't save you tax, I'll take you. So we're both glutton for punishment like the Bears for some reason. And so after looking at it, he wasn't incorporated. We set up an S Corp, took salary plus dividends. That saved $10,000 a year. We employed a few other tax strategies, saved another $10,000 a year, and we were able to amend and get $100,000 back from the amendment. We did cost segregation with his building, which wasn't ever done, which accelerated the depreciation. And so there's a lot of tax savings. Fast forward years and years and years later, he calls me. He's like, I'm going to jail. I'm like, not surprised. What'd you do? I mean, just joking with him. And he's like, no, I'm going to get audited, and there's no way I could have ever saved that. I said, okay, here's the deal. We're going to make another bet. If in the audit you owe money, I'll cover it. Don't worry about it. I already knew we were clear on that. I said, but if we save you money in the audit and get more money back for you, you have to take me to another game and a better steakhouse. And so we saved him $5,500 because there was a lot of things that were minor things we weren't writing off, like the vehicle usage and a couple things like that. So we just got more aggressive because we were organized. We presented the cost segregation study. We showed the reasonable salary versus other chiropractors, which this guy was. And by the end of it, we got money back. So don't attend, stay organized, have a good team, and then get aggressive on where you might have additional savings. That is key. All right, the 10th one. The big mistake people make is they don't look at the scams on irs.gov and justice.gov. Justice.gov shows you the tax promoters that are under scrutiny or that are, having issues. I had people came and say, oh, what's really great is a charitable LLC. And they explained it to me. And they're like, sounds like self-dealing, which means we're just doing it for tax purpose and we're taking the money back. It's not really benefiting the charity. And so I called someone that is a tax lobbyist. I said, what do you think about charitable LLCs? He said, let me introduce you to this attorney that just deals with that. And he just works to go help the tax promoters that are going to get in trouble with him. So scared the crap out of me. I was right. Well, I didn't want to listen to it again. I was like, but then I looked at justice.gov and there was a ton of those promoters. IRS.gov, it might have certain strategies like their dirty dozen where you're like, oh, wait, conservation easement. Remember, you can do those legally and ethically, but if you get into a group of people, it might not work anymore. So you have to look at the context. But the biggest issue that people have is not reporting their income. If you don't report your income, that's going to be a problem. I mentioned self-dealing with charitable LLCs. It's like, oh, you're just doing this so that you could benefit and it's not actually benefiting someone else. You just got to look for these tax promoters that are doing illegal things. So let's recap. Look for the scams. If it sounds too good to be true, look it up. If you have a fear of an audit, you don't have the right tax team, and there's nothing to be afraid of if you're organized and you have your team handle that. I've been audited twice. No big deal for me. One of them, we had a lot of real estate, and I was a real estate professional, which meant I spent more than 750 hours a year doing real estate, and so I had major write-offs there. I ended up owing $300 after one of those audits. Not because I truly did, but it was just like we were done if I paid the $300 versus fight it. That was just the cheaper way to go. And the other one, I didn't get money back, but I didn't owe anything. So I had nothing to fear. I've used what I'm telling you here, right? I've been doing this for 25 years, and we just haven't had any issues with people being audited other than people that didn't claim on their 831B. That's a captive insurance agency. They didn't make their claims, and so they had to pay back plus a penalty. Or early on in my career, I made 2 mistakes. Didn't tell someone to pay state tax on the sale of a stock. I wasn't their accountant. I was just the financial person, but I was all right. I paid that. And then someone that was going through an audit when they were transitioning to work with us, and their other accounting firm said it was our fault. It was a few $1,000s. Like, we've just been doing this for a very long time, and I'm not into doing anything overseas or anything that's not down the fairway, and have so many good people I can talk to that are so dialed in. And like, I have my good friend Justin Donald just went through an audit. We did a whole presentation to his lifestyle investor group about what it's like to defend an audit. We brought in Jeff Soha, who helps me with my tax side of things, and he talked about all the reasons that people get into trouble with tax. So, there's no reason to fear this. Now, it's important to go back and review your past returns every 3 years. You might have missed something you can amend. Don't spend to save. That doesn't make sense. If you're not reclassifying your income for tax, let me talk about what that is. An LLC can have a partner, and you can now tax as a partnership. You can tax an LLC as an S Corp if it makes sense for Section 199A or for some other reason, or maybe because you're the only person in it and it doesn't make sense for an LLC for an individual person. Or you can have a C Corp, where you might have a medical reimbursement account, which could be tax deductible, or you can retain earnings, or on the first dollars you earn, that corporate rate is cheaper than having a pass-through entity like an LLC or an S Corp. Now, these are things that you want to talk to tax professionals like CPAs, tax attorneys. I'm here to give you the framework and plant some seeds and give you some ideas. If you're looking for help like that, go ahead and get my tax navigator by going to Garrett B. Gunderson on Instagram. You can check out, follow me there. But just put tax navigator, I'll hook you up. And if you're saying, I want more support, we've got programs to support you with this. We can help analyze your taxes. So a lot of people miss deductions because they have conservative accountants. They have one-dimensional planning without enough a team. They defer, they have fear, they're reactive. These are all the things we've covered. So every 3 months, meet with your tax team. Every 3 years, get a different set of eyes. And just make sure you have really good, organized financials. I just feel like too often people are afraid, or they think they need to pay tax because it's their duty. But let's think about this. Between excise tax, property tax, self-employment tax, sales, there's so many different taxes that we're paying more than our fair share, especially if we're not looking at that tax code that says, hey, if you're providing things for people because you're a business owner or you're a real estate investor, the things that the government's not really great at providing, you get tax incentives. You get tax benefits for that. If you don't take advantage of those tax benefits, you simply tip the government. There's no thank you that you get. And yeah, I'm always going to look to earn more money and pay more tax than pay less, because even if it's inefficient, it is going to some degree of good. It's just that I would rather take that money and invest in my business and my employees and even in my quality of life, because every time I drive my vehicle and I'm using gas, I'm paying an excise tax for that. So when people go, oh, well, what about the roads? Well, I'm paying excise tax. What about this? Well, I'm paying property taxes for kids' education. There's all of this tax that we pay. There's no reason to pay more than is necessary with your income tax. So another reason why people overpay is they're just worried about the switching costs. Oh, I've been using this person. I want to hurt their feelings. Well, a lot of times we'll work with people that have their existing tax team. We're fine working with them. I had this dentist that we showed him how he had a lot of different practices. We showed him how he could save, I think it was somewhere around $250,000, and his accountant only agreed to 125,000 of it. Still, it's $125,000 more, and his accountant and him were in the synagogue together. He was like, this is one of my best friends. I'm like, great, still gets to be your accountant. We'll just give some additional strategy that they can implement. So it's not even that you have to switch. I know a lot of people that once we had this business owner that we held these 3-day workshops, and they're like, can I bring my accountant? I'm like, yeah, the accountant was their dad. And the first day, the accountant's like reading the newspaper, super annoyed. By second day, I start doing tax strategy, comes up, how you do this and this. She joined the program. He's like, I love working with you guys. We weren't trying to replace his job. We're trying to do the things that it's really hard for that. We don't file taxes. People have to file taxes. That takes a ton of time. This is a collaborative event. It's a collaborative way of doing things. So what would Jesus do? Or what would money Jesus do? WWMJD? Well, first off, let me be clear. I may look like Jesus, but I know I'm not Jesus, because that Jesus saves and I spend. Plus, my mom wasn't a virgin. And to be fair, I don't think Jesus ever actually had to deal with money, or wife and kids for that matter, which makes me wonder why you never really see a picture of him smiling. Do you not want to let us in on that secret? Every picture should be of him smiling. Kidding. Love my wife and kids. But here's what WWMJ would do, all right? Look back over the last 3 years. Get a different set of eyes on your taxes. Properly document and meet every 3 months. So when you spend, just have a good documentation process. There's apps that are good for it. You could do it in a simple way, like just writing next to something on a credit card statement. Ask better questions when you're in these meetings. You know, we've had meetings where we have the tax team on and I tell some jokes, we laugh, and then we just brainstorm. And sometimes those brainstorming sessions are things that, you know, like I was renovating an office and they're like, oh, well, your father-in-law was a contractor. What if he did the renovation? You paid him and then he can give money back. I'm like, no, that's brainstorming, but it's not ethical. So everything's on the table in the brainstorm, but then we say, what can we actually do? And so I'll ask questions like, well, what's the best thing you've done for another client since we spoke last? Are there any new tax law changes or things that you've discovered that we haven't integrated? Are there any areas where people have write-offs because they're a specific type of business that doesn't apply to some of my businesses, but I have multiple businesses, so maybe we could do that. And finally, just make sure you have an attorney. If you're a business owner, set up a corporation. It's going to save you tax, but then you don't have unlimited liability and you have less chance of audit. And if you're really successful, get a tax attorney and help reclassify your income. Look, this is money you can put back in your pocket, improve your quality of life, invest in your infrastructure, invest in your investments. This is something where you can invest in yourself. Simply, this is one of the biggest line items of expense that you're ever going to have. And if you can minimize that, that is money to the bottom line. That's money that can come in and year out. So, save tax, improve your life, and contribute more.